now. We have John Stoltzfus. He's Managing Director and Chief Investment Strategist at Oppenheimer Asset Management, joining us right now. John, good morning. Great to have you with us here. And apologies if I I got the pronunciation wrong. Prashant this side, and good to see you here on CNBC-TV18. John, what's the view as far as sort of global markets go? Are we in a way coming to a bit of a head? In India, we've had a bit of a pullback over the last 2 or 3 weeks. Actually, the only first real kind of pullback we've had in the last 1.5 years. In the US, the market continues without a correction, although many are pointing to worries about the extreme concentration that we are seeing, and a few stocks which are kind of leading that market higher. Just assess the situation for both these markets, because these are some of the best performing markets in the world over the last 2 years or so. Go on.
Well, I think one of the things that we would need to note is that anytime you have an extraordinary run-up in equity prices, you have to take a look and see what really is driving it. And in this particular case, what we've got in the U.S. is a situation where indeed the Federal Reserve has been remarkably successful at lowering the pace of inflation while still finding its target of 2% elusive to some extent at this point, with inflation still stickier than one might expect at this point after, 11 hikes and 5 pauses, and likely another pause tomorrow. But the expectations are that it's progress, not perfection. And in the U.S., we've seen, with technology still leading stocks higher, a broadening of the market. Now, we would also expect, however, that as you find stocks at higher levels, the question is, trees don't go to the sky. There's just no doubt about it. They may look like they go, but what is going to stop or slow the move? We would have to say at this time that likely it is a question moving forward as the market ponders the effects of central banks on a global basis and the effects related to inflation, developments in terms of the diversification of the global supply chain, which is occurring, and the implications for the global economy. It essentially would appear to us that what we have here is a market that is driven on fundamentals and prospects that indeed we may be moving towards a global economic recovery that is rather remarkable, driven by technology, and also in terms of demographics around the world, an appetite for equities that has not been really seen for some time with such extensive upside for so many months. So it's normal for markets to question that. Volatility should be expected, but we would have to say that innovation and the process of central banks around the world working to curb the pace of inflation, and the remarkable success that has been had in general in the U.S. and elsewhere around the world, that this likely could go on for longer. But the most important thing for investors is you need to be diversified, and a right size expectations is what we would suggest.
Got it. So how are you approaching a market like India now? It's been a very, very strong run up until now, but now there's some signs of correction. Do you think the correction could extend itself over the next few months?
I think, it will really depend as we go forward on the fundamentals that would be related to earnings moving forward, to what the inflation rate is on a regional basis. But we'd have to say that, it's after you get significant run-ups, it's inevitable that you will find some profit taking. And the profit taking will often take into account that in a situation where you've been in a market that has been driven longer, higher for longer, is how good is the catalyst to justify taking profits without FOMO or fear of missing out. So we would say that when a market begins to show some form of correction, consider the intermediate to longer term trends. Investors need to recognize, are they traders or are they intermediate to longer term investors? For traders, any kind of volatility is time for action, seeing what can be done in the course over a few days or a few weeks. In the case of intermediate to longer term investors, pullbacks like these has been occurring outside of the U.S. In India, we would have to say may offer an opportunity for investors who may have missed some things because prices had moved up too high to do some dollar cost averaging or find places where they are able to initiate new positions on where intermediate to longer trends could justify that type of a move.
All right. Hi, John. Good morning and good to see you in. Nigel on this side. John, at the start of this year, you were talking about the S&P 500 hitting 5,200 by the end of this year. At the end of the first quarter, we're almost there. So what's the revised target on the S&P 500, point number one? And also the Federal Reserve, what kind of action are you expecting it? Earlier we were anticipating maybe by March we get the first rate cut. Now it appears it's the story of June and it's not confirmed as well. So how many rate cuts do you expect from the Fed in this year?
Well, first, we would say that in December, when we put the 5,200 target in, it was, I think it was about the second week or so of December that we did. A 5,200 target was the highest on the street. I think there may have been somebody else. I think it was Tom Lee was around that level. I think he was at 5,200, either just before us or just after us. I don't recall. But we were in the forefront of the targets. But the market rally that started at the end of last October kept roaring right into this year. Now, we'll say this. Fourth quarter earnings, we think, justified that additional upside that we saw in the U.S. market. We think that we saw some, with the volatility that we saw, as I recall, in February, when the market began to question how many times the Fed would cut rates this year. Remember, at the beginning of the year, the Fed fund futures were thinking that the Fed might cut 2 to 7 times this year. Our thoughts have always been for this year, with inflation the way it's looking, would probably be what the Fed has intimated, 2 to 3 cuts in terms of interest rates this year. And we think that happens in the second half of the year, perhaps as late as the fourth quarter. We also believe that when the Fed does begin cutting rates here, it could very well be that the U.S. is not in a recession, nor is looking like it's going into, but that the Federal Reserve actually feels later this year that it has raised rates enough over the course of the last 2 years that it can bring inflation to a proper conclusion here, with the opportunity to see an end to the Fed funds hike cycle without actually reaching a recession. So our 5,200 target, if I could just say this, we will address, if the market closes at or above 5,200, we will have to at that point consider if we're going to raise our target or leave it the same at that point.
Okay, John, we'll let you go on that note. Thanks a lot for joining in and speaking to CNBC-TV18. That's Oppenheimer Asset Management, talking about how you should approach the market from here on. Let's